Well, welcome back, everyone. This has been just such a great conference. I just was in the green room with, our speakers who we'll introduce in a second, but just the conversations around yesterday and today have been really incredible. So excited to be a part of this. I'm here with our experts, Lily Trager, Director of Investing with Impact at Morgan Stanley Wealth Management, as well as Jim Lumberg, co-founder and executive vice president of Envestnet. So thank you so much for being here.
Thank you.
So our morning sessions talked a lot about these new segments of investor growth, whether they be millennials, women. But I just wanted to talk to you guys and have you give us a little bit of your background and how you got engaged in impact investing, responsible investing. Maybe Lily, we'll start with you.
Sure, yeah, happy to. Thank you for having us here today. It's good to be on a panel with my friend Jim. He and I always get to talk about climbing mountains together since Jim is an expert in that area and I am an amateur. So if anybody else wants to talk climbing mountains afterwards, let's do it. And building sustainable and impact investing into your own practices is somewhat like climbing a mountain. So you may hear more about that metaphor. But for me, I always knew I wanted my career to be dedicated to sustainable and impact investing. And what really catalyzed that decision was an experience I had as a junior in undergrad studying abroad on the island of Madagascar, the world's fourth largest island. And I was an anthropology and a French major and thought I was going to be the next Margaret Mead, hiding in bushes, studying foreign cultures. And instead, I found myself while in Madagascar spending all of my time with women entrepreneurs, which was perhaps no surprise, having been raised by a single mother who was incredibly independent and resilient and an entrepreneur in her own right. And so while I was there, I learned the stories of these women who, frankly, had started a business from nothing. No formal education, very little access to capital and sort of the traditional financial services industry. But having started a business allowed them to really provide opportunities for their families that they hadn't had. Access to private school or, Paris correspondence courses or, engaging them to participate in civic society and become a local politician, helping to better their community and broadly their country and the world. And so when I came back as a bright-eyed senior in college after that experience, I knew that was it. How do I use the capital markets to transform them to make a positive impact in the world? And really from the beginning dedicated my career to that. That was 2005, so a little over a decade ago. And today in my current role, I'm really focused on wearing three main hats at Morgan Stanley Wealth Management. The first is increasing education awareness of our 16,000 financial advisors. The second is really focused on providing the most innovative and high-performing investment strategies and solutions. So that's model portfolios, right? That's related to thinking about our innovative, structures and finance opportunities. And then finally, it's really related to building tools, analysis, and providing resources to our clients and their advisors to really accelerate the flow of capital towards sustainable and impact investing. So that's a little bit about my story.
That's great. Jim, what about you?
Awesome. Well, unlike Lily, I didn't know initially that this is where I wanted my career path to lead. After graduate school, I spent time in Africa, in Liberia. I was a school teacher and worked at a leprosy colony and learned very quickly that individuals can make a difference in the world. There's no doubt about it. We've all had that experience in our lives, but it was shaping and informing to me. Lily brought it up, so I'll build on it. One of my other personal passions is climbing. I'm trying to climb the tallest mountain on every continent. And it's taken me to incredible places, but it's made me realize that climate change is real. I can see it in Kilimanjaro, where I've been going for 10 years and seeing the glaciers recede. I've seen the effect of global conflict, climbing in the Caucasus Mountains of Russia, or the power of microfinance and the ability to change communities by investing in women entrepreneurs. And even today, I operate a school in Tanzania. I've been there for about 15 years. And firsthand, I see the power of infrastructure investments or microfinance for women in entrepreneurs or others. So my personal life has been shaped by a recognition that we can make a difference and that there is a need to make a difference. Professionally, I am a co-founder of Envestnet. My first job, I was 10 years with Naveen Investments as a portfolio manager, and then went over to co-found Envestnet. And my role there has all along been to build new businesses. And in 2008, about 10 years ago, we recognized as an organization the importance of sustainable investing. We felt that it was a compelling business opportunity, but culturally as well, it just reflected how we wanted to, who we wanted to be as an organization to help others make a difference in the world. So it really has been a crossing of paths of both personal passions and professional opportunities.
I love to hear these stories. I know Rami opened this up this morning by saying 20 years ago, even 10 years ago, where were we, and were we ever thinking we would be here today talking about, these really important issues and, going on that journey. Really great to hear. So when it comes to engage and grow and growing the new investors that we were talking about, is it business as usual? Do you see it in your work? Where do you find, best deployment of resources, their new strategies? Maybe Lily, we'll start with you.
Sure. So we all know, everybody in this room knows better than anybody that it is certainly not business as usual, right? That the value of advice, right, and what's being required of us as advisors stewarding our clients, both individuals and institutions' assets is constantly changing, and dramatically so in many cases. And so, part of that redefinition of value on behalf of our clients is really understanding how their investments align with the type of world they want to see, right? One that is, better for employees and communities, better for the environment, right, and mitigating the worst risks of climate change, and certainly better governed with a higher level of integrity. And so it's incumbent upon us, as you heard as part of the intro, as advisors and wealth managers, to really integrate that value into our day-to-day business. And that takes time, that takes energy, that takes resources, that takes wherewithal, that takes connecting to the broader community that has been engaged in this space. One of the most successful ways which we've seen established teams really start to integrate sustainable and impact investing into their business is to think about it as an intergenerational growth opportunity, right? So not only intergenerational in terms of the types of clients that you're engaging with, so using this as an opportunity to, if you've typically been speaking to the patriarch in sort of an individual or family type client, right, using this as an entree for a conversation with the matriarch and the next generation. But also, if you take a mirror to each of your practices, intergenerationally as part of growing your own team, right? And thinking about, looking to find team members that may look more like your clients and less like you, given what we know about the average financial advisor and given what we know about the future of investors tending towards, women and next generation. And so thinking about, finding somebody who has, whether it's passion or interest and experience in the area of sustainable and impact investing, to embed inside of your team as part of just, healthy succession planning and building a more diverse team that can be more resilient given what clients' interests are in the future. But bottom line is, right, this issue, sustainable and impact investing, should matter to each and every one of you because it matters to your clients. And that's really why institutions like Morgan Stanley and Envestnet have really established this as a business imperative as we seek to provide the right tools and resources to our advisors and their clients, because it's critically important to delivering value and treating our clients as a whole person.
Yeah, I'll just pick up on something Lily is talking about, and that's the immediacy of the opportunity and acting now. We talk a lot about this transition of $30 trillion or the next generation as though it's somewhere out in the future, and that when that happens, then as advisors we'll do something differently. But the opportunity really is now. It's, as Lily was saying, for advisors to engage now with the matriarch, with the next generation, if for no other reason, to make sure that those individuals know that the advisor has this capacity, this willingness to talk about impact or sustainable investing, this acumen, because if they don't introduce those ideas, when the wealth transfer does happen, it could be over. I mean, there may be alternatives already in place. So as we think about empowering advisors and helping them with the engagement, really it begins with awareness. And all of you are aware of this opportunity, but not all advisors are, as a business imperative to grow their practice into the future and to think about the next generation of their own practice, and also to think about how they can deliver better outcomes for their clients through the strategies of implementing sustainable investing. It's helping them to become confident and competent in talking about sustainable investing or ESG investing. We know that advisors are not going to talk about something that they don't feel confident and competent about. And to give them a path to enact sustainable investing into their practice, whether that be through research or through overlay or investment solutions or practice management, really helping them to endorse, adapt, feel confident about it, and then introduce it to their clients. So the immediacy of the opportunity is here. It's not something that we're waiting for in the future.
Yeah, I think that's a great point, particularly with the results of the poll that we just saw before we stepped on stage. And, you know, how do you see speaking clearly about responsible investing to a new investor? There are so many acronyms, right? We've thrown them around today: ESG, impact investing, investing with impact, CSR. You know, how do you see sort of breaking through some of that jargon and really conveying what responsible investing is and why people should be doing it?
Would you like?
You can start.
Okay, I'd be happy to. You know, I think it is confusing. Sustainable investing, ESG investing, SRI investing. You know, there are lots of acronyms, and from a technical perspective, they mean different things. But I think at the end of the day, it's for the advisor to engage without the acronyms, without the technicality, and just to develop a deeper relationship to say, you have tremendous resources, or you have the beginnings of tremendous resources, whatever the case may be. But you have resources, and these resources have the opportunity to do good things, to provide for you and to your family, but also to make an impact in the world. And to understand really what's important to the investor and what their aspirations are for their resources. And to begin there, I think that whatever acronym it is, that's the root of what we're trying to get to. So to engage at that level, and then to understand what the aspirations of the investor are, and then to build on that.
And I would just add that, you know, think about the traditional investing conversation that you have with your clients. And when you sit across the table from your client at a quarterly meeting, right, do they say to you, Mr. or Mrs. Advisor, I'm really looking for an optimized index product, right, that'll give me a tracking error of less than 1.5% exposure to a broad market index? No, right? They're saying I want a fee-efficient vehicle that I know will perform similarly to what I'm reading in the paper in terms of how the market's doing. I can't stand with these sort of big swings up and down relative to the benchmark. And you are interpreting that into a product. Think of it the exact same on the sustainable and impact investing side of the equation. Your client's not going to sit across from you necessarily, given where the market is today, although there certainly are clients who may in the future, you know, and say, Mr. or Mrs. Advisor, I'm really looking for a, you know, environmental, social, governance, integrated strategy that's actively managed, right? This is part of risk management and the upfront way in which they're analyzing companies, right? They're going to be looking to you to help interpret their long-term goals and aspirations, right, as Jim said, into the context of what makes sense in their portfolio. So what we believe at Morgan Stanley is that there's really 4 main approaches to delivering positive environmental and social impact alongside market rate returns. And those are along a continuum we call our investing with impact framework. So we think of investing with impact as the umbrella under which all of these different approaches fit. And they're really about leaning out of certain sectors, companies, geographies, right, negative screening, leaning in towards certain sectors or themes, right, more of a thematic exposure, using this pool of environmental, social, and governance data, the operational CSR side of a company's practices, to evaluate a company and make an investment decision, or impact investing, where the entire business model of the company is really created to generate positive environmental and social impact. And while there's absolutely impact investing opportunities in the public equity and fixed income market, still largely a private or alternative product and solution set. So if you kind of understand those 4 key tools and approaches, then you can really help to interpret what are the investments that are on your own platforms at your firms, and what might be the best tools as you're thinking about building out a diversified portfolio. But you need to first understand, what are the motivations driving your clients? Are they coming to this conversation because they think it's an arbitrage opportunity, because they think it will help them to avoid certain pitfalls and risks and position them for opportunities? Or are they coming to this conversation because it's more of a values orientation, and they have certain values that are driving their investment decisions and that are important to their legacy and to stewarding their family or institution's assets? And so there might be different motivations, which will ultimately be really important indicators of what solution set might be most appropriate for clients. And we think of this as a long-term journey, right? Especially in the taxable client space. It's going to be very rare that you're turning over a portfolio from 0% impact to 100% impact overnight. It's going to be a very long-term journey of evolving a portfolio based on liquidity events, based upon opportunities to transition out of strategies, and based on interpreting your clients' sort of ever-evolving priorities, both in the financial realm and in the impact realm.
It's a great way of approaching it and really understanding, what your clients care about, and finding strategies that work within that framework. Sans all of the alphabet soup, if you will. I worked in city government for many years, and I had finally mastered, every government acronym, and then I came over to Bloomberg, so I understand the apprehension there. But when you break it down, they're just letters. Jim, I just wanted to ask you a question about digital strategy and how you see that playing into the future, also in engaging millennials specifically. Where do you see digital?
Yeah, we think it's critical, and some of the panelists before, I think, did a really nice job of talking about the differences of the way that millennials want to engage with a financial advisor and how they've been informed and shaped as investors, whether it's been the Great Recession or other impact. But it's no secret that millennials interact and have trust and work better digitally than other generations. It's a medium that they trust. It's a medium that they feel comfortable with, and they want to receive and be informed, not exclusively, but in large part through digital methods. So as we talk and work with advisors, particularly those focused on next generation investors, millennials and others, the digital medium is incredibly important, because it's important that advisors meet investors where they are, communicate with them in ways that they feel most comfortable. So we think digital is a really important part of future advisor success.
Maybe just to build on that, absolutely agree with everything Jim said, and we really think of our financial advisors as adding value in a technology-enabled environment, right? One that can absolutely integrate with digital channels, whether that be sort of technology platforms to deliver investment advice that can be customized, like our Morgan Stanley Access Investing digital platform, or whether it be in kind of social media channels and thinking about engaging with clients, individuals, and institutions on issues that matter to them. And we certainly have a lot of sustainable and impact content in those channels. But as a somewhat reluctant millennial, we were swapping Instagram hashtags in the green room, and I think that it's important to have a presence in the digital channel, but I think what really differentiates you all in the room is the human touch. And as advice requirements become more sophisticated, like myself, I have a 2-year-old, and when my husband and I were married and started our family, we determined that we really needed to evaluate who was our financial advisor, when historically maybe we were under the impression we could manage our own wealth, and that was done to our satisfaction. As life becomes more complex, right, as needs become as time, frankly, becomes more scarce, you want to work with an advisor who can really have your back and can really connect with you at the human level. So it's a tech-enabled environment, right, with digital applications, but really emphasizing as well just how important the human touch is to bringing these conversations alive and engaging with clients.
And let me build on that, because I think Lily is exactly on the mark. The digital enablement, so it's the human touch that informs and frames and teases out passions and then translates those into an actionable plan. Digital is super important. And on the back end, we've talked a little bit this morning, some of the earlier panelists, about reporting, impact reporting. And we feel that digital really has an opportunity to bring the value proposition to the investor in a more immediate way. You think about the traditional way of working with an investor. It's to have a quarterly performance report and to try to map that back to goals and objectives, whether it be retirement or growth or whatever. But in this sphere of impact investing, it's critically important and increasingly important to be able to talk about not only financial measures of success, but the impact of the investments in real life in terms of carbon emissions or fair labor practices or good governance. And digital media is a terrific way to communicate those value propositions and to track the impact of investments in a way that I think is really powerful, in a way that we're very focused on. I know that Lily is as well. We see that this is a really important part of technology going forward to support the business.
Absolutely.
And do you find that showing that performance and measurement is very important, or something that specifically millennials and women are looking for or asking for in your experience compared to maybe other types of investors?
Well, I think everyone wants to know the results. They have an aspiration for the money, whatever that may be, however those are measured. But how are we doing in terms of fulfilling those results? Now, we're seeing that millennials and women increasingly have a concern about impact and the effects of their money. So just as important to seeing what your return is, it is how has my money impacted the world? Has it fulfilled the things that we've talked about at that human level for the aspirations of a portfolio?
Totally, and just connecting the dots between kind of impact reporting or integrated reporting with financial reporting and growing your business, right, as we potentially head into a period of increased volatility where, in certain cases, it may be a more challenging quarterly meeting on the subject of financial performance, right, given some of the outlooks that exist today, including our own, right? Think about how you can continue to engage with your client on issues that matter so much to them, right? The quantitative side of the difference they're making in the world, right? And the qualitative side of how they're improving lives and the environment through their investments, and using those stories and opportunities to build the entire picture of providing value to your clients instead of just leaning on the quarterly financial metrics,
Absolutely.
which again can be challenging.
Lily makes a really good point, particularly if you're of the school of thought that we're entering a period of increased volatility. Study after study shows us that the stickiness of an investor to their plan, if it goes beyond just financial, if there's some deeper meaning to the resources and the way that it's invested, the money becomes more stable. The investment plan becomes more long-lived, and it helps an advisor to be able to show a multi-dimensional element to an investment plan. Yes, there's going to be volatility and at points perhaps pain in terms of ups and downs, but one consistent thing that could be pointed to as a value proposition is your money is working in other important ways, and it just creates a deeper, more sustainable relationship, I think, with money and reduces the volatility of it.
That's a great point. I think now Lauren has some questions.
We do. I think we have time for 2 questions.
Great.
For clients and prospects that are unaware of investing with impact, how do you effectively integrate that conversation into the discovery process?
Great. So first of all, whoever asked that question is very astute.
Yes.
Because this absolutely should be part of the upfront conversation around understanding your client's objectives and thinking about your client as a whole person, not just a kind of, KYC list of risk and return priorities, right? So understanding what's important to your client in terms of their own legacy, understanding in terms of what priorities may define that individual and their family, thinking again on a personal basis about the conversations my husband and I had with our financial advisor when we were asked to truly take an inventory of our personal values that may ultimately influence our investment decisions and how we allocate our capital, right? We disagreed. My priorities were related to empowering women and girls and climate change. His were related to education and Jewish values. And so as we think about integrating those in the context of using our financial advisor as somebody who can help us to navigate that, understanding that values may be different across family members, understanding that values may change over time, and so you really have to make that upfront investment as part of the discovery process to spend the time to get to know what matters to your client and recognize right up front that this is a journey and that their values are likely to change over time and that the investment solutions and strategies that you have access to that help them to express that will also change over time. But just very quickly on that, because I saw one of my colleagues walk in the room a few moments ago, we had a very interesting story about coal bonds at Morgan Stanley, where essentially a financial advisor who had gotten to know their client and knew climate change and gender was important to them decided one day to buy some coal bonds in their portfolio. So that client left the firm, right? This was a $300 million family office. And so that was literally a lack of listening to the client in terms of their upfront objectives. And years later, thankfully, that client reached out to the sustainable and impact team and said, wait a second, we see Morgan Stanley as a leader in this area, connect us to an advisor who can truly help us to implement these goals and understand what our objectives are more than just our risk and return profile. And we did, and they've had a very successful relationship with the firm. So this can really be a way for you to win new business, but also to retain business as this conversation becomes increasingly important.
Great. Are there changes needed to the compensation packages for financial advisors to encourage impact investing?
I would hope not. I would hope not. Most of the advisors that we work with are fee only. So they have an advisory fee that is an umbrella over all different aspects of their investments. They should be neutral in terms of selecting investments, really being driven by what's best for their clients. So that's the world that we live in. I would hate to think that we had to entice advisors in some way financially to be on board.
You know, I agree with Jim, and I think it's obviously important to build a structural framework that has incentives aligned towards sustainable impact investing. So one way you could do that today is understanding the asset managers that are on your platform, and many asset managers are actually starting to codify incentives around integrating environmental, social, and governance criteria into the investment selection process to their analysts. Right? And that is an aligned incentive, right? Being able to think about that is something that could better serve your client ultimately and that you may have access to. So understanding the incentive structures inside of some of the asset managers, and I know our ESG-focused analysts on our global investment manager analysis team are really dedicated to understanding those incentive structures inside of asset management firms, because I think that actually can help to catalyze the incorporation of this data as part of the investment selection process.
I do too, and in terms of financial incentives, but as Lily speaks to it, it's broader. Advisors should be incentivized beyond just the financial remuneration. And what we find in working with the advisors that we serve is that there's a business imperative and that they should be motivated by participating in one of the fastest growing segments of the investable marketplace. That impact investing allows an advisor to have conversations that goes beyond retirement or the fundamentals of finances to really what are you passionate about, and to develop deeper, more meaningful relationships with their clients that help sustain through times of turbulence. But also it allows them to build better portfolios and to deliver better outcomes. I mean, we could have a whole conversation around the academic research that supports ESG as a strategic way to build a better portfolio. But if someone feels invested in their portfolio beyond the finances, it just leads to better outcomes. So we think advisors can benefit from their business, deeper relationships, and better results, and be incentivized by that.
Great. So there you go. Thank you so much, Lily and Jim. I think this was really great insight into engaging and growing the next generation.
Thanks, Victoria.